Hey everyone, and welcome to Exchange Traded Fridays, ETF.com's weekly podcast series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, you probably already know what we're going to be talking about: tariffs, trade wars, and how they're shaking up the ETF market. We've seen some wild swings in the markets thanks to the latest round of Trump tariffs that just went into effect. European defense ETFs are surging, tech ETFs are taking a hit. It's been all over the place and it's been an absolute roller coaster. We're going to recap and break it all down for you. Then we're going to shift gears a little bit and zoom out. After all of the volatility that we've seen this year, what are this year's best performing ETFs and worst performing ETFs? There's quite a few surprises in there. You won't want to miss that. So stick around because we've got a lot to discuss. Joining me today are my esteemed colleagues, Senior Editor Kent Tooney and Contributing Editor Ron Day. Guys, always great to be here with you. How's it going?
Glad to be here, Sumit. It's going well.
Going well.
Great. So, Kent, I want to start with you. You've been talking about and writing about tariffs a lot. And, even on this pod, we've been talking about tariffs for weeks, even months, ever since Trump got elected. Last month, he proposed these 25% tariffs on Canada and Mexico, but no one really took them seriously, right? And you can't blame them because he ended up delaying them for a month at the last minute. So after a month goes by and the new deadline is approaching, investors are thinking the same thing is going to happen, that he's going to delay the tariffs. But no, he didn't. Lo and behold, March 4th rolls around and they actually do go live, which shocked almost everybody and sent the markets tumbling. So, Ken, let me just ask you right off the bat, were you surprised by what happened with these tariffs this week?
I wouldn't say surprised. I mean, like you mentioned in your intro there, I mean, we've been thinking about this, talking about it, writing about it for months. I mean, ever since Trump won the election, he talked about that even during his campaign. So we knew tariffs were coming in some shape or form. To your point, there may have been some surprise that Trump's standing down on these tariffs. It might be a little surprising, but I mean, we're just a little ways into it, but I wasn't expecting anyway. We see treasury yields falling, which would mean, prices are rising. And that's because of consumer sentiment. Consumers haven't been following this news. They don't think about tariffs that much. They hear about it and they're like, oh wow, that's something the government does, and they don't really dig deep into it. But they're seeing prices remaining high. They're seeing news headlines about tariffs, and that's really denting consumer sentiment. We had one of the worst consumer sentiment reports come out last week. And even Walmart and big box stores like that are talking about soft guidance coming forward. They're expecting sales to come down. And so now suddenly people are talking about recession. So my surprise is that I thought that yields would continue to push higher because investors are thinking about, oh, tariffs are inflationary. So they're going to push yields higher, expecting inflation to go higher. Now we have a slowing economy. Two-thirds of the economy is consumer spending. And so when they're not in a good mood, that changes everything. And even corporations, their sentiment is souring a little bit because they think, oh, well, our profits are going to be hit. And so now we're talking about recession, but inflation's still there. So now we're
Yeah.
talking about stagflation as well.
Yeah, great point, right? I mean, when we talked about tariffs after Trump got elected, there was this uncertainty. Are they going to be inflationary? The initial thought was, yeah, they're going to be inflationary somewhat at least because they're going to raise consumer prices. But to the extent that they reduce consumer spending, they could also be deflationary. It's really hard to, suss out what it actually means for the economy. But so far, we have been seeing more of a deflationary effect, and bond yields have been coming down, which is kind of interesting. We're now actually seeing Fed funds futures markets pricing in three rate cuts for 2025. If you look back a few weeks ago, they were only pricing in one rate cut. So clearly, they're betting on the Fed coming to the rescue here. We'll see if that happens. So you mentioned the bond market, Ken, but we're also seeing obviously a ton of volatility in the stock market, where the S&P 500 actually fell into the red for the year, down 1 or 2%. But not every sector is getting hit equally, isn't that right?
That's right. We're seeing classic defensive sectors like consumer staples. That's the XLP ETF. Or healthcare. I mean, that sector was, I think, the worst performer last year. When I looked, it was up maybe 2%. And you have technology, up, say, 25% or so. And so their healthcare stocks, that's XLV is the ETF, is the top performer so far in 2025, up to over 7%. And then utilities, which already had a pretty good year last year, they're another top performer. And well, the top performer is not a sector, it's really an asset. That's gold. I mean, gold is
Right.
is when those prices are high, that really sends a signal that the market is concerned, that these are safe haven assets and defensive sectors going up. So that's a bit of a surprise as well.
Yeah, of course. And we can't forget about consumer staples, another kind of defensive sector. XLP is a popular ETF in that sector. That is one of the best performing sector ETFs. I wrote a piece that's kind of similar to yours, Ken, highlighting the different sector movements. And what I found interesting is that the S&P 500 is down a couple percentage points, like I said, 2% or so, but only 3 out of the 11 sectors are down this year. There's actually 8 sectors in the green, uh, even though the market is down this year. And like we've been mentioning, healthcare has been doing well. Real estate has been doing well thanks to those lower interest rates. So these are all keeping the market from falling even further. What's weighing down on the market actually is those tech stocks. We've seen a big drop in NVIDIA, that's weighing on the tech sector. We're also seeing a big drop in the consumer discretionary sector. Presumably, this is one of those sectors that's going to get hit the hardest if consumer sentiment takes a hit and consumers pull back. There's also the risk that prices, margins will compress because a lot of these consumer discretionary companies, they'll get hit hard by the tariffs. So we're seeing a big divergence under the surface when it comes to U.S. stock market sectors. So we've said, the S&P is down 2% this year, but I think one of the most fascinating things we've seen from everything that's gone on this year with regard to trade wars is the massive, massive surge in European stock ETFs. And surge is the right word because no one would believe this, but the German stock ETF, EWG, is up 23% already this year, new all-time high. Who would have thought? Because, I mean, Trump is threatening to put 25% tariffs on the EU. Obviously, Europe's economy has been kind of stagnant recently, yet these stocks have just been exploding to the upside on the prospect of greater government stimulus coming out of some of these European governments. Earlier this week, Germany's incoming prime minister, he said that they could be spending upwards of 500 billion euros on infrastructure in that country. And that doesn't even include the billions of additional spending that he wants to do on defense. Of course, President Trump has been kind of skeptical when it comes to NATO. He's been kind of threatening to, in some cases, leave that alliance. In other cases, he said that he wouldn't defend certain NATO countries if they didn't increase their spending on defense. So Germany seems to be taking that seriously, and they're planning on increasing defense spending. And presumably, if they do that, they're going to be spending on European-based military products. So we've seen this one ETF. It's called Select Stocks Europe Aerospace and Defense ETF, ticker symbol EUAD. You will not believe how much this ETF is up this year. 42% just in the first a little over 2 months this year. I mean, who would have thought, right? A European defense ETF is acting almost like a tech stock, and it's because of this whole idea that Europe is going to have to spend much more money on defense. And when it does spend that money, it's going to be spent on European companies. So, I mean, we'll see what happens with that. There's so much craziness going on in the markets. Every day we're seeing new headlines when it comes to tariffs and trade wars. It's really unpredictable. What can investors do in this environment? Is it just kind of hunker down and stick to your long-term investment plan?
Well, it sounds boring. What a key theme and what I'm communicating to my own clients is diversification. I mean, some of the sectors that did poorly last year or last quarter, the quarterly reports that I send out to clients, I'm explaining how, we had a mixed fourth quarter, but the first quarter, a lot of the sectors that we hold long term, such as healthcare, they were laggards, and now they're leading. So it's really a testament to diversification. I mean, we
Right.
talk about these things all day. I've been managing assets for 27 years, but you just don't know what's going to happen in the short term. So you just have to hold on and hold your conviction holding is what I call them. If you believe in it and they're strong long-term holdings, then if anything, if you have some extra cash, add to it. But I'm really in a hold position where it could continue to fall. So you kind of prepare for these type of things in advance, especially if you have a short-term time frame or you're already retired. You should already be well diversified. So that's my response.
Yeah.
Yes, Samit, I spoke with Alan Roth yesterday for a few minutes. Our columnist Alan, and he was saying that there's a lot of concern, a lot of worry. He's a wealth owns an investment advisory, and he says, stick to your plan. Don't do anything radical unless you know something the market doesn't. And he also, put in a pitch for investing in international.
Yeah, yeah. For many years, there's been questions about whether investors should even have international stocks in their portfolio. It's times like these where you can see the benefit of that, right? US stocks have been doing relatively poorly, but international stocks have been doing well. So it's been good for portfolios that hold those type of stocks and ETFs. So we'll keep a close eye on things. That's great advice from Kent and Ron there. Stick to your long-term plan. If you're a long-term investor, if you're a short-term trader, obviously things are different. This is the type of volatility you live for. So have fun with that. Ron, I want to zoom out a little bit now. We've talked about the recent volatility, but you wrote an interesting couple of pieces highlighting the best and worst performing ETFs on the market today. Were there any surprises on your list?
They were all surprises.
Oh, yeah.
Everything just kind of seemed out of the ordinary, like unexpected. And again, this was just for February. Um, so we did the five best and the five worst, and I think all you can kind of tease out of this is it just things feel kind of chaotic. There were among the best and the worst, there was nothing. And again, these kind of get skewed because it's about percentages and not the biggest flows or inflows or outflows. It's just speaking of performance. But, we didn't see like any broad market funds.
Uh-huh.
There were no no bond funds among the best, and and there were no broad stock funds among the worst.
Do
What
these
was
include leverage and inverse, or are they
No, no,
excluded?
no. We pull out
Gotcha.
the leveraged ETFs. So, um,
What I'm seeing there, Ron, was what that I thought was really the thing that just struck me was, and since we follow these things, this covered call strategies. I mean, the top performer was BABO, BABO, and that's a covered call strategy that uses Alibaba stock, and so that stock is high, and so it speaks to when you can profit the most off of a covered call strategy. You want the market to be kind of moving sideways or up to
yeah.
benefit from those. And then your worst performer is a covered call strategy on a stock that has performed poorly. I think it was CA3 or something like that.
What's it?
And so
I'm
yeah,
sorry. Go ahead.
those strategies are going to go down in that environment.
Well, it's funny because YieldMax had two of the best performers and three of the worst performers, and they were all these option income ETFs that aim to draw or pull income. I guess they're using swaps and call options, but they're using generating income from these very volatile stocks or more or less volatile, right? So as you said, Babo, an option income strategy, was the best performer during February, and then so let me go over to the worst. The worst performer was another Yield Max ETF, which was yes, that was following or tracking, generating income from the ticker AI, which is C3, C3 dot AI, which is obviously an AI company. Also performing well was natural gas, and that was more well. There's also a Trump play with that because I guess Trump is aiming to uh, develop U.S. Fossil fuels, so that is helping UNG. I think there's also kind of some issues about supply with natural gas right now. And I'm not entirely sure why this dry bulk shipping ETF, BDRY, was also a top performer. Um, the only bit of information I was able to kind of turn up was that they're charging more for rates. I don't know. It's because I'm not, I'd have to drill down a little bit more into that, but you would think tariffs and a trade war would be hurting shipping, but I don't know the industry well enough. But again, this,
Interesting. That's interesting, Ron. Yeah, you would think with all the trade wars, international trade will eventually be reduced, which means, you need less ships to
yeah,
ship things around the world. But that may be the case ultimately, but in the short term, we've actually seen a surge in imports, especially in the U.S. because these tariffs everyone was anticipating they're going to go into effect, so they kind of front ran them, and we
hmm
saw a surge of imports into the U.S. as everyone tried to buy everything they needed ahead of them. So that could be a lifting shipping rates. I'm not sure. I haven't dug deep into that either, but this is one of those ETFs we tend to see on the best performing list one month and then the worst performing list another month. It's just a very volatile
it
ETF.
is. And I
But
don't
go,
know if
yeah,
they manage their ship inventory in a way that they kind of, I don't know, do they dry dock stuff just to kind of keep rates high? I don't know. I don't know the
yeah.
industry.
We're gonna have to have someone on to explain the intricacies of the shipping industry to us. But
Yeah.
going back to that Babo ETF, that's actually the second best performing ETF of the entire year so far. It's up
Right.
44%. And that's it seems great, but then I just plotted it against BABA, the actual underlying Alibaba stock, BABA. BABA's up 65% this year. So it's up
Wow.
significantly more than this yield max strategy, which is what you would expect, right? If you're writing
Right.
covered calls on a surging stock, you're not fully capturing the upside. Your shares are getting called away. So that
Yeah.
is obviously always the risk of a covered call strategy. If you expect a stock to go through the roof, you don't want to necessarily write covered calls on it. It and on the other hand, if BABA was sinking, if it was plunging, the yield max strategy would do better than the underlying, but it
Yeah.
wouldn't fully protect you. I mean, you'd still be losing money. So I think these strategies can be somewhat controversial, especially when you put them on these volatile stocks. It's like if you want to benefit from the surge in this stock, I mean, you might as well buy the underlying stock. Why are you
Yeah.
kind of cutting off some of your upside there?
I guess, yeah, maybe it's just if it's a fear, kind of a fear play, it's like you're mixing your fear and your optimism.
Yeah,
So,
yeah. It's interesting. And I will note BobX, BABX, the 2X long BABA ETF is the best performing ETFs if you include leveraged ETFs. It's up
yeah.
157% this year. So Alibaba has been a very popular name when it comes to these leveraged derivative type of ETFs.
Let me just quickly mention a couple of the other, I mean, the other poor performers were a VanEck digital transformation ETF, which was, they had a lot of Bitcoin miners in that one, and Bitcoin had a terrible February.
Yeah.
Another yield max that dealt in the company formerly known as Square, which is now Block, also did poorly. There's another Bitcoin miners had a rough month, the WGMI, and yield maxes uh, covered call option income ETF CONY, which tracks Coinbase, was the I guess the number five among the worst
A
for
lot of
February.
crypto losers there, Ryan.
Yes. Yep.
Yeah. Yeah, so that'll also be interesting to watch. We did see kind of like this almost like pump and dump style move in crypto prices. We can't forget about that, where Bitcoin, Ether, all these cryptocurrencies surged after Trump announced there would be a strategic crypto reserve, but they gave back all of those gains almost in the next 24 hours. So tons of
Yeah.
volatility there. We'll keep a close eye on it. I think that's a good place to wrap it up. I want to, thank our listeners for tuning in to Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, join the conversation with us on X. Our handle there is ETFCOM. Catch you next week.